All right, so welcome to another video, and today what we're going to do is we're going to go ahead and take a look at a 0 days till expiration or 0 DTE SPX Iron Condor. I'm going to share with you just a couple of basics in this video and give you an overview. Later towards the end of the year, we will be doing a 0 DTE class, so you'll definitely want to make sure you check that class out later on and subscribe to the newsletter if you're brand new. You can do that on our website at tradersfly.com. There's a lot of classes that I typically do throughout the year, a lot of them on options related things, so definitely check that out. All right, so let's kick things off and get things started. I want to go ahead and get moving. So I want to share with you how a 0 days till expiration Iron Condor works. So the whole premise behind a 0 DTE trade is that these trades expire right now, today. Now, today's is April 18th. By the time this video comes out, it'll probably be a couple of weeks later. So I want to just show you the basic concept behind it. We're going to be trading the 0 days options. You're going to put them on that same day. Again, I'm not recommending this or anything like that. I'm just showing you the premise of how this works and how it makes you money. So the reason you might want to do this is there's no overnight risk. So a lot of people, they go ahead and trade options and they say, okay, I'll go 20, 30 days. But there's a lot more complexities with longer dated options because you have to take Vega into account, price wiggle, you might need to do adjustments, that kind of thing. With 0 day options, you don't really have that. However, there is kind of a thing that people get sucked into. They go in and they get sucked in because the theta is fast, right? We get sucked in because at 0 days, your theta decay curve is the quickest. But remember that the risk is also the highest. You have an extreme price risk when it comes to 0 days till expiration. Because if you go in and you trade the 0 day options and you're trying to get them to expire like today, right now, and you're trying to collect, let's say $1, the dollar that I'm trying to go ahead and collect is at 43.50. Now the current price is at 43.78. So that doesn't give me a lot of wiggle room. Now let's go in and again, I'm doing this a little bit after the market's opened. It's already like noontime. So you probably would do this more towards the morning because the premiums already came out, but this is the opportunity I have to make the video. So now I wanted to give you a quick shout out from our sponsor. Before you make any trade, you can verify it with VectorVest. Their free stock analysis report tells you what a stock is really worth and how safe it is. And it even rates it whether you should be a buyer, seller, or hold the stock. So that way you can invest with confidence. If you're interested in VectorVest, check out the link in the description below or visit the website vectorvest.com. So if we go with about 25 strikes, you can see I'm going to be at 43.50. And right now, current price is 43, almost 80. So 50 to 60, 60 to 70, 70 to 80. I'm about 30 points away. Now, if I go even just to 2 day options to try and collect $1, let's just go, we got to go a lot wider. You could see I could go, there's 50 strikes. Let's go 90 strikes to collect that same dollar. I could go into 42.10. So just going a couple of days later, you are able to get much wider on that spread. So look at this now. To collect that dollar, I'm at 42.10. So the difference there is huge. So it gives you, what, an 160 point range in general. So you get much wider on that put side just for a couple of days more. So be very careful trading 0 days to expiration options because you're going to be very close to that expiration. And in the morning, you would have got maybe, 43.20 or so, a little bit wider there. So the whole point behind this is if we're looking to go ahead and capitalize from that expiring options, I'm going to go ahead and try and get somewhere between a 10 and 5 delta. So here is kind of my delta of about 8, somewhere around here. So I want to start my short position somewhere around this range. So I'll start it here, buy some protection about, 20 to 40 points out. And then I'm just going to try to make sure that this stays above or away from my short strikes. There's not much I can do. It's basically, if it starts going against me, you take it off for a loss. There's not a lot of Vega components to deal with. The time decay is extremely fast. The big downside is if price moves against you, it can move just 5-10 points and you get hammered and slammed. So be very careful with these trades because they're very risky from that perspective. So I'm going to go ahead and set up kind of this trade right here and go in and do, this one's 15 point range. Let's go a little bit larger. Let's go about 20 point range. So you're collecting $1.15. So if we look at this spread here and we look at the risk profile picture, Okay, so here we go. And I'm going to switch the date to today. Okay, so now what I'm trying to do is collect about $115. Now the risk I have to put on is $1,800. So to be able to make 115. So on a percentage basis, that sounds like what, about 6-7% or so. I mean, you could do the math and calculate it, but about $115 on almost $2,000. So about 5-6% maybe. And what you can do is put on this trade, and you could do each side individually. You could leg into it, and I could say, hey, I'm going to go ahead and leg into this trade, and I'll right click, confirm and send. I'm just going to put it into this IRA side account. And now we're in that trade. So as long as this now expires above that price, I collect $115 at the end of the day. So you can see the current price, the market's kind of pushing higher. So this could be a good way to put on the put side. Now, when this goes in over here at the upper end, probably earlier in the morning would have been good to do the call side. You could enter the Iron Condors all at once. You could do them legging in, meaning right here I'm doing one leg, and I will do the other leg here for you as well. So here I'm going to go in and just do the same thing on this side, just to show you different range here. There we go. So now I've got this other side right here, also about a 10 delta, and you can see I've got a wide range. So I've got 10, 20, almost 30 points on the downside, 10, 20, 30 points on the upside. Go ahead, confirm and send it into that range, and we'll see. There we go. Now we're in the trade. Okay. Ideally, it's nice if the stock or the SPX would have popped a little bit and then I sell it, or in the morning I would have sold the call side and then I sell the put side on the downward. And now I've got a wider Iron Condor. But again, I've got 30 points up or down, and that's a bit of the issue. So if this thing explodes at the upper range or the downside, I'm in trouble. So I'm at 43.50 and 44.10. 43.50. Let's just zoom out. 43.50 and 43.10. So I've got some bit of a range over here. So let me go in and put on my other platform here so you can kind of take a look at it. So here, okay, so 43.50. There we go. It's one trade I did earlier, 43.50. And let's see here, where are we? Trade tab, 44.10, 43.50, 44.10. So I don't have a lot of range right here, 44.10, right about that range. Okay, so there's kind of my range. So now that stock is moving, I've got this range right here where this stock, if it just hangs out here, I collect that full premium. Now that full premium that I make is about $205, but the risk I have to put on is about $1,800. If it expires, great, works out, no problem. If it doesn't, I'm in a little bit of a problem then. If it pulls back, how much do I want to risk? Well, if I'm making about $200, let's just say I'm making $200 every time I do one of these trades, 200, 200, 200. If it starts going against me, you probably don't want to risk more than about $350, maybe $400, about 2 times, maybe 3 times. You have to make that determination. How much drawdown are you willing to have? So if I had 3 times, that would be 3 times 200, about $600 loss. So that means that I can actually go and test my break evens and then come back up and I'd be okay. So 600 is almost at that break even on that side. 600 over here is also a little bit closer to that break even or a little past it. So it gives you some of that room and wiggle room by going like, 1.5 to 2 times what you're risking, and it allows the probabilities to kind of work in your favor there. So you can do something like this. You could also go in, and I'll just show you with the 2-day range, just also to show you the big range that you could have with a 2-day. You could just put the Iron Condor in all at once, okay? And we'll do that over here, 44.65 and 85 right here. So if you do just all the Iron Condor all at once rather than legging in, that's also another way of approaching it. But you can see here, by doing a trade like this, just to show you the big difference, the range, you're going to be able to get a much wider range. Like just the difference in a few days, look how much wider this Iron Condor is, which is a 2-day versus a 0-day. And that is because that premium is just totally gone from those 0 days. You've got only so much room here. Whereas the 2-day all of a sudden has much more range. However, you do have that overnight risk. So with the 2-day, I say be a little more careful and cautious with these because there's no room for adjustments on a lot of these trades. Even with a 0-day, there's not a lot of room for adjustments. You could tweak the trade a little bit, put on a second trade throughout the later part of the day. That's only if you put one trade on in the morning. But if you didn't put a trade on in the morning and you're kind of doing it like, in the afternoon, there's pretty much no room. It's a put on, take off kind of trade. It's a no touch. You could see since we've been talking, we are now up about $12 on the position, now 15. And that's just the time decay is just extremely fast. And as long as that price holds, I should be able to get out with that $205 profit. Where this fits in your portfolio is that let's say you've got a $10,000 account. Maybe you can use $500 of your account for trades like this. And that is because they're more volatile, they're more violent. But don't think about using, $9,000 of your account if you've got only 10 grand. That's like 90% of your account in these trades. And that is because what I've mentioned earlier, yes, you do get a fast theta, but shorter duration increases the risk of the price. So you got more price risk. And with more price risk, you're basically adding more risk to a larger part of your account. And that's a big no-no. And that's what a lot of people get into trouble is, let's say you've got a $100,000 account and they try to do trades like this, and they use it with all their account. No, this is just going to be a sliver of your portfolio. It's going to be one of the things you do. You might do, again, another sliver for penny stocks. There's nothing wrong with penny stocks. Just use a sliver of your account. You could do other day trading. Again, just a sliver. But then other parts of your portfolio, let's say over here, you've got a lot of your theta trades. Then you might have other parts where it's long portfolio trades. So mix and match different concepts and strategies in your account. But these are higher risk trades. It's not that you can't do them. Just understand they're higher risk because with a shortened duration, you get much more movement and you get less price range. And that price risk just accelerates in a big way. And if it moves against you, you can get into some serious trouble. Anyway, we're going to go ahead and do a live class on this probably towards the end of the year. So I want to let you know just some of these things, what they are, and you could slowly start playing with them if you're interested in it. Nice way to play with paper money and paper account if you're kind of brand new. But they are higher risky trades, higher risk trades, but you could do them consistently Monday, Wednesday, Friday on something like the SPX or the Russell. And, some people do well with them, but just remember they're more risky and you need to be a little bit more careful. Anyway, thank you so much for joining me. Hope you enjoyed this video and enjoy the rest of the week ahead. And I will see you in the next episode.